As a part of this session on capital modeling, I would like to first look at the operational risk capital from the Basel's perspective. What is that the Basel has been offering? In Basel 2, we can look at in depth for typical market risk, credit risk, as well as operational risk. So, what are the different kinds of mechanisms that are used for determining the risk capital under the operation risk category? So we'll talk about the basic indicator approach, the standardized approach, and an advanced management approach. And we'll spend some extra time in terms of understanding what this advanced management approach is bringing into the system, which also includes specific usage of loss distribution approach for modeling the operational risk related capital. And we'll see how some tools like Monte Carlo simulation as well as scenario analysis can help us in achieving this kind of a goal. And how can insurance play a role with respect to the capital modeling? Now, this is what is the typical set of topics that we are going to take up. So, initially to get started, I would look out from the perspective of the Basel 2. We know according to Basel 2, there are three major mechanisms that are being suggested for operational risk capital, right? To evaluate or to compute operational risk capital, we have either the basic indicator approach, the standardized approach, and the advanced management approach. And here, these two approaches, when I'm looking at, more or less similar. They try some multiple of the gross income. Simple. They are taking the gross income and some multiple of the gross income either at the overall business level or typically at the separate line of unit level, right, or line of business level. So that's the only difference. But advanced management approach, we know that it is giving more and more weightage to the calculations internal. The company can drive and create its own computations for coming out with the capital requirement. And probably this is more targeted to the companies which have really good risk management practices with respect to operational risk, wherein the companies, because they have invested heavily in all these, there is a possibility that they can have lower capital requirements regarding the same. So this is a kind of a measurement which advanced management approach is going to bring. And probably even from a Basel's perspective, it is more and more encouraging the banks to come out with internal models, which are more and more sophisticated, which take into account lots and lots of internal data, right? And so probably if any bank is comfortable in using an advanced management approach, that's the one that is getting more and more preferred, because when you look at the basic indicator approach, probably it's as simple as 15% of the gross income of the bank over a year, right? Annual gross income over a last 3-year period. That's it. So you take the average of the last 3 years gross income and multiply it by 15%. So when I'm saying gross income here, I'm looking at both interest based income, net interest income, as well as non-interest income also. So all incomes put together. And if it is negative, it would not be counted. Only if it is positive, it would be counted. So while taking the average, let's say if the if the gross income in the last 3 years, let's say, has been 10 million minus 5 million and 15 million, then the gross income, the average gross income, I'll take it only based on these two. So which is 25 divided by 2, which is 12.5 million. I'll take only the positive. I'll not consider this negative here. So, and even divide it only by 2, not by 3. So on this 12.5 million, I'm going to compute the 15%. This is what is being suggested by a basic indicator approach. Straightforward. Only annual positive gross income over the last 3 years. And I am dividing also while taking the average number of years over which the gross income is positive. And here if we see, it's a very straightforward. It only requires gross income. It does not require anything. It is not working on loss data. It is not working on any kind of scenario analysis. Nothing. It is purely looking at the gross income, and based on the gross income, some kind of a 15% factor is getting applied, right? And what we also see is, if two companies have the same gross income, irrespective of what kind of risk management practices they have implemented, both of them will have to have the same capital requirement, which means it looks more and more simple, but may not be reliable for all businesses. So the reliability is always a question mark when I look at the BIA model, right? Because having revenue as the only driver and no other process relating to risk management, implementation of the risk controls, makes this model more and more limited in its usage. But when I come to this standardized approach, right, the standardized approach typically called as, so which would be denoted as TSA. Now this standardized approach, probably there's not much of a difference. Okay, there it was the gross income that is taken at the overall business level. Average gross income was taken at the overall business level. Now this entire business is broken into 8 business lines. The overall business got broken down into 8 business lines, wherein there are different weightages that are being given. Instead of a flat 15% across the overall business, now 8 business lines typically being broken down into corporate finance, trading and sales, settlement and payment. These 3, they carry 18% weightage instead of a flat 15%. These 3, the first 2 are a part of investment banking, the corporate finance operation, the trading and sales operation, settlement and payment kind of operation. They have an 18% weightage. Then we have commercial banking. Commercial banking operation is having a 15% weightage, along with agency and custody services. So these 2 carry a 15% weightage. And now when I see remaining operations, especially the retail banking, asset management, as well as the retail brokerage, so all of them they have a slightly lesser chances of operations risk. So that is where we are bringing in 12% weightage to these departments. So this is the only difference which the standardized approach has brought in comparison with the basic indicator approach. So for each business line, I'm looking at the gross income, right? I'm looking at the gross income over a 3-year period. Instead of looking at it across the organization, I'm looking at for each business line and then multiplying it by the constant factor. So we are looking at factor wise here or business line wise different business activities across each of the lines. So if the company is performing different business activities in different proportions across each of the line, there might be a difference between the basic indicator approach versus the standardized approach. And the other thing is, in the basic indicator approach, if the total gross income was negative, we completely omitted it. But here, I can negate the negative across that particular year up to 0. So basically, it is like I will add the gross income of the first department multiplied by the weightage of the first department, 18%. Gross income of the second department, I multiply it with the weightage of the second department. Like that, I add up, right? I add up, and at the max I can take it, even if some of them are negatives, they cancel out each other, but the sum should be positive. But the final sum should be positive. And if it is negative, I'll still include it, right? Probably if I'm seeing that after I did this entire sum, let's say for 3 years, for the first year I got it as 10 million, for the second year I got it as minus 5 million, and third year let's say I got it as minus 15 million. In a basic indicator approach, we would have computed, we would not have taken these two. So the average gross income I would have taken as 10 million directly. Whereas in case of the standardized approach, I'm not taking 10 million as the gross income and I'm not multiplying it by 15%. I'm typically considering this entire, even I'll take the 10 million, but this 10 million I'm dividing by 3, not by 1. That's the major difference that is coming out between these standardized approach, because I will allow this summation up to 0, means this value I'm not ignoring, but I'm going to take it as 0. After all the weights have been applied, and if I have got it if I have got the summation as 10 million, I'm going to take 10 million, but if I'm getting minus 5 million, I'll take it as 0. That is one major difference which we can see, right? And on the same lines, just like a standardized approach, we have a slight modification called alternate standardized approach. Basically, this is talking about slightly handling the double counting aspect. Some risk gets double counted, especially for retail and commercial. And retail and commercial, we see that here we get both, in both the cases, we get the same 15% weightage itself, right? And instead of taking the gross income for these two lines, we are talking about the loans and advances only, which are there as a part of this department. This we are multiplying with some multiplier, and generally this multiplier is around 3.5%. Whatever the loans and advances are there, for these business lines, we are multiplying it by 3.5%. So what we are typically doing for computation of the commercial banking and the retail banking is we are taking a 15% of, instead of taking the gross income of these two, we are talking about the loans and advances that are given by these particular departments multiplied by a multiplier of 3.5%. That's the only difference which an alternate standardized approach is bringing in. But okay, now coming back to this point, when I am having negatives, right? If the gross income, or if the final, whether it is the gross income mechanism or the basic indicator mechanism, if let's say after all calculations I am ending up with something like this in terms of my total income, either it is department wise, 8 business lines wise multiplied and finally arrived at, or total gross income, whatever it is. So if this is the basic indicator approach, we would have taken that the total capital requirement is 10 million times 15%. Whereas when I am going with the standardized approach, I will take it as 10 million divided by 3 times 15%. So which means in the standardized approach, the capital requirement is coming very much lower, especially when the negative gross income is cropping up. The way these two models are handling is completely different. Now this is where, okay, there is a kind of a motivation for the banks to typically go with this, especially when they are having negative income, and it is distorting, the capital requirement is getting completely distorted. So that is where they have brought in under pillar 2 supervisory review of the Basel 2, they said the additional capital should be added, especially if the company is having negative gross income. It is talking about the adjustment where additional income can be added under the supervisory review aspect. So that's one change, or that's one important point from the perspective of Basel regarding the difference between the standardized approach and the basic indicator approach. Now, moving on to the next one, which is the advanced management approach. Here, the banks have the flexibility to build their own models. The banks can really assess the pattern of their own data, right? And they can create their own distributions. They can follow their own mechanisms provided they get reviewed and approved by the authorities. But the main thing, few important points that all the models which are developed internally, they have to be met is the fat tail losses. These models should have the potential to capture even all the fat tail losses. So 99.9 percentile events within a 1 year time horizon. The model should definitely able to answer all these losses. They have to pull the data from internal loss data while building the model. They have to use internal loss data, external loss data, which are both historical related, scenario analysis, which is more a visualization of the futuristic losses, and business environment in which the current business environment in which they are operating, country specific, internal control factors that are there, something like insurance taken, some such kind of internal control factors. All of them need to be considered as a part of building of the model. And they have to allocate the capital, any allocation of the capital, it has to be purely incentivized to improve the business lines. It's not a short term risk taking strategy. The incentive should be typically given towards improving the risk management practice. And here, very straightforward way, okay, there are 7 risk categories that are identified. Right, 7 categories of risks, and we are talking of 8 business lines. So business lines and different kinds of different risk categories across the business line. So 7 by 8, around 56 cell matrix is getting formed, and the loss data is coming out for every cell. Right, there is a matrix kind of thing that has to be formed. So the capital requirements have to be made for all the 7 risk categories. So it could be done first like initially the firm can allocate the capital at the entire business level, and from there it can percolate to the different risk categories or business line level, or it could directly start doing the allocation at the business line level also. But whatever is the mechanism, a few interesting quantitative things need to be captured. All expected and unexpected losses related data has to be captured. The approach, whatever they are going with, it should be able to capture all unexpected as well as the expected losses. All the fat tail events need to be captured, and sufficient detailing out for the same need to be done. And every cell need to be populated. Right, this entire cells need to be populated and then computed, and any kind of correlation that can exist between each of the cells, there should be an explanation for the same. And typically all these 4 data elements, the internal loss, the external loss, the scenario analysis, business and environment internal control factors, all 4 should be included as a part of the model, but with different weights depending on the kind of risk that depending on the reliability of the data and depending on the kind of risk the company is visualizing, the weightages for each of them can be different. But in reality, what happens is, at the max, in building the model, they might use 1 or 2 of these 4. Probably some models they build only with internal loss data, but probably do some kind of testing out with the other data elements. So they can adjust the models with the other. They build it only with some of these 4 elements. Probably internal loss. If I look at the loss distribution approach, to a large extent it relies only on the internal loss data. So there could be a few models that are built purely on the internal loss data, or only taking one or few of the data elements and complete the model, perform the stress testing and adjust the model so that it can accommodate all the remaining 4 elements as well. Now let's get into one specific approach on this same lines, which I am calling as the loss distribution approach, LDA. Mainly it relies on internal loss data. Right, this entire approach is based on internal loss data. So these are the only inputs, and all the 3 they are purely for stress testing purpose. whether it is external loss or scenario analysis or the business environment, internal control systems, all of them are for stress testing purpose itself. But of course, the more and more the data they have, at least 5 years, last 5 years of internal data should be there so that they can try capturing almost all the elements, right? And it is purely historical data, so there are always a positive side to it as well as the negative side, right? The data collected probably could be for a very small period of time. So not all fat tail events might have been captured or occurred during that period. Heavy losses, if they have not occurred during the last 3 years or 5 years period, they might not have even got reported, which means 99.9% confidence level might, the data at to provide a 99.9% confidence level, the data may not be sufficient. So building a model may have its own limitations. And at the same time, there is always an argument that historical data not necessarily not needed to be a reflection to future. If that's the case, everything that is based on the past data, we always make the assumption that the past will reflect the future. But here probably again there is always the other side, because it's always argued that the business changes, the products changes, the control changes. So whatever the data, whatever the risks or whatever the losses that have occurred in the past, we might have very well learned from all those losses and mistakes. So there is a very rare chance that we are going to do them again and again, right? So this is one small disadvantage that can lead with the loss distribution approach. Now, when we are talking about the loss distribution, there are two major components in this. One is the loss frequency, right? We are looking at the distribution relating to the frequency of losses, distribution relating to the severity of the losses. So frequency, probably when I am looking at trying to model it on an annual basis, the general distribution that is being followed for that is the Poisson distribution, right? And Poisson distribution with one single parameter lambda. We know that the mean of this distribution is lambda, the variance of this distribution is also lambda. So lambda typically represents the average number of events in a given year. So I can very well observe the number of internal loss events, calculate the average. And it can help me in terms of arriving at probability. What is the probability that in the next 1 year, the number of losses will be a particular number, or will be greater than this number, will be lesser than this number. Now here, if we are seeing, if the lambda is more and more lesser, we see a very high positive skewed kind of a distribution. The lesser is the value of lambda, we see a positive skewed kind of a distribution, along with it being leptokurtic as well. Kurtosis being much high, skewness being much higher. These two will become the characteristics of a Poisson distribution where the lambda values are much, much smaller. But when it comes to severity, okay, there are very wide number of distributions. At least any kind of a fat tail distribution is much more appropriate for modeling severity. The first thing that is more simpler to model is based on a log normal distribution with parameters mu and sigma squared. If a particular data is following log normal, the logarithm of that will follow a normal distribution. But if the frequencies are much, much lesser, okay, now when I bring it or link it with respect to frequency, if the frequencies are much, much lesser, We can even have a kind of gamma distribution or some kind of modified beta kind of a distribution or generalized Pareto distribution GPD, which is an extreme value kind of a distribution, or Weibull kind of distributions. All these are still better when the frequencies are much lower, typically called as low frequency high severity kind of risk. For these kind of risks, any of these distributions are better. At the max, all I have to do is come out with each of these distributions and finally do a goodness of fit test. Which of these distributions is fitting much appropriate to the data? But the common thing is, at least I will not use normal distribution here, because I am of the opinion, or I am very much convinced, that the data should be fat-tailed in nature, and it can't be a normal distribution, because the loss data are more and more fat-tailed. So I need extreme losses coming up. So some kind of a positively skewed kind of a distribution is very much essential for modeling the severity of the losses. And sometimes what I can very well do is, now that I have got a frequency distribution, now that I have got a severity distribution, I can very well combine them into a Monte Carlo simulation. I can simulate, okay, initially I will generate some occurrence of the Poisson distribution, some number of losses based on the Poisson distribution lambda. So there is a random generation of a loss, and corresponding to that number of losses, for each loss we will generate an amount based on either the log normal distribution or any of those distributions regarding the severity. And using these two, we'll typically try to come out with overall loss amount. So like this, we generate some thousands of scenarios. You just try to visualize. Okay, let's say I'm talking about a log normal. Initially, let's say I'm talking about lambda is 3. Based on the lambda being 3, randomly I am going to generate some number of losses. So let's say the first iteration has given me that there are 4 losses. What is lambda 3? The average number of losses. So randomly I have generated 1, and let's say I have got 4 losses. Okay, now for the 4, I am trying to generate individually I am trying to generate the severities. Now let's say severities is following a log normal distribution with mu of 5 and variance sigma squared of 3 something. So based on this, I'll get S1, S2, S3, S4. Four different generatings of the severities I am doing. I am adding these 4, which will give me the first loss instance, the total loss amount in the first occurrence. Then again I am generating one number for the number of losses. Let's say this time only 2, which means from the severity distribution I'll generate S1 and S2 and say that this is the loss amount 2. Like this, I keep generating some 10,000 occurrences of this. I get so many occurrences of the losses. I get 10,000 occurrences of the losses. Now I am taking the distribution of these loss events. This distribution may or may not be analytically tractable, but through the simulation, I could very well compute even the 99.9% confidence interval limit, because out of the 10,000 data points, if I want to meet 99.9%, it is the 0.1% on the negative side that I have to typically take. So 0.1% out of the 10,000 is the 10th element. So I can very well go ahead in terms of finding out what is the typical operational risk loss that I can, the 99.9% confidence level point I can very well handle through this Monte Carlo simulation approach. So majority of times we are combining them to estimate the capital that is required, right? So primarily what we are trying to do through this simulation is we are trying to generate huge number of data points so that the likely losses for the next year will be covered at 99.9% confidence level. So using this Monte Carlo simulation, we are combining the distribution of the frequency as well as the severity using a process called convolution. And we are producing huge number of data points with the same characteristics. So the frequency is going to follow Poisson distribution. The severity is going to follow either a log normal distribution or any other similar kind of distribution. And from each of them, initially for the frequency I am drawing, then for the severity corresponding to that frequency, for the severity I am drawing, and totally summing it up to form the loss event for that particular one instance of that loss event. Several thousands being created like that, I get a loss distribution. And within that loss distribution, I am trying to find out the 99.9 percentage element, which will give me that below this, all the losses would be covered with 99.9% confidence level. This capital is required. This much capital can cover 99.9% of the losses. So that is one major thing that we can do using the loss distribution approach. And if I typically see, okay, I'll try to introduce you to scenario analysis. Whatever we have done till now in the loss distribution approach, first of all, the distributions have been built based on the historic data, right, and purely internal loss kind of a data. And we did not talk anything about the future in any one of them. Even in the Monte Carlo simulation, we have made an assumption that the future might be a reflection of the same distributions which we have built using the past data. Whereas the scenario analysis is more targeted towards fat tail events. So I create my own scenarios, right? I create my own scenarios, nothing to do with the past, okay? The number of losses are 10. And the severity of the losses, I can take it very much on the higher side. Right, S1, S2, S10, they will be on the higher side, and that is one loss that can come out. Now, the scenarios are designed in such a way that they are going to reflect the future. What if the average loss is going to increase by 20%? Because all this entire approach of loss distribution, which we have built on the historic data, is purely based on the past. Here we are creating the scenarios which are futuristic in nature. But the biggest problem is to what extent I can visualize the future. It is purely subjective, right? I may be using some unwanted kind of scenarios also, or probably implausible kind of scenarios. So how realistic are these scenarios is something that drives the effectiveness. And at the same time, the data points will be much lesser. I may not create hundreds of scenarios, very difficult for me to visualize. So the techniques become more and more complex. If my data points are much lesser, the techniques becomes more complex to come out with the loss distribution. So this is one major disadvantage that comes with the scenario analysis kind of an approach. And even if I'm changing the assumption slightly, it could impact the calculations very widely because the data points are much smaller. And at the same time, I don't have the data output, which means whatever the model, see, probably if I'm looking at historical data and trying to build a model with them, once the model gets built, I might test them on the historic data because I have the real actual output of that historical data. Whereas when we use this, we don't have the output. So I can't test the model at all. So I am directly rolling it out for the future, which will be another major risk. So this is where if I am relying purely on the scenario analysis, it's always difficult. And in terms of estimating the risk capital, and the program requirement becomes more and more robust. Heavy testing, heavy development makes the situation more and more riskier. So it's always, I mean, we are seeing that in United States and all, purely scenario analysis based models are not accepted. They can be hybrid models, means they can be combined with loss distribution approach. Probably, okay, in case of hybrid, what is being suggested is you combine the loss distribution approach with the scenario analysis. How can I combine? Okay, instead of taking purely the past data points, you also consider some scenario analysis based data points. Take all of them. So some kind of loss events that have occurred in the past and some kind of the data points that you visualize for the future. All these data points, you typically combine them and go ahead in terms of building your model, both for the frequency as well as the severity, which means even the future is being considered. Or you say, for all expected losses, I'll go for a LDA based approach. Only for unexpected losses, I try out for a scenario analysis kind of an approach. So some such kind of combinations, hybrid kind of thing can be brought in. But in isolation, the pure scenario analysis based models are typically not accepted in the United States. Though there are some kind of models that are accepted in Europe, we don't see a wide acceptance for them in the United States. And now, looking at the other aspect, which is the business environment specific or control specific within the organization, there is some kind of a mention to look at the insurance as a dimension. See, probably we all know that insurance is a mechanism to reduce severity of the losses. When I am insuring something, I am reducing the severity of the loss. I am bringing in more and more. Stability into my gross income or probably profitability, and reducing the volatility in terms of my losses. So there is a possibility for against all these operation risk, banks can typically insure themselves. Typically, if you see some kind of employee fraud, some kind of professional liabilities, against all these things, the bank can typically go for an insurance. Now, the amount of insurance and for against what kind of risk they have to go for, again, it's something which in some of the areas there are already mechanisms that are available, whereas in some of the areas the research is still going on. And now, if the bank is using an advanced management approach for computing the operation risk, it can very well consider the insurance to reduce the capital because it is bringing in more and more stability. The variability is coming down, but it is limited to the extent of 20% of the total operational risk capital. So it can bring down the operational risk capital at the max by around 20%. Now, by including the insurance, the aggregate loss distribution might change drastically because The severity, it is impacting the severity, so the severity distribution will get changed, but the distribution associated with the frequency will not change at all, right? So the severity will be reduced, which means the distribution will get altered, which means all the risk capital computations also will get altered. Now, how well this can be taken forward, insurance companies are really doing a research in terms of coming out with new products which are in line with the Basel requirements, so that they can typically insure the various operation risk event and typically improve their business, and at the same time from the company's standpoint, from the bank standpoint, they are able to mitigate their operation risk by adopting the externalized kind of a suit, which is the risk transfer mechanism of insurance. So it is reducing the aggregate loss distribution, and if at all really any company is using insurance for that specific purpose, the loss distribution approach model should definitely include them. And it is going to lower the severity, but of course you can't expect anything with respect to the frequency of losses. So this is what we are supposed to understand regarding the capital modeling aspect of the operations risk management. All right.